Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 317 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including market breadth, revision on annual jobs numbers, S&P 500 performance following 100-day rallies of 25% or more, the current bull market, and aging parents checklist. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Alrighty. Welcome to episode 317. We'll jump right in with pricing as we usually do. The S&P 500 is up 1.1% month to date and 11.1% year to date. The Dow Jones Industrial Average is down 0.1% month to date and up 6.9% year to date. The NASDAQ Composite is up 2.0% month to date and 13.3% year to date. The iShares Russell 2000 ETF, think small caps, is up 0.5% month to date and 7.0% year to date. And the Vanguard FTSE All World ex-US Index Fund is up 1.6% month to date and 22.8% year to date. Across the yield curve, the 3-month Treasury rate is sitting at 4.09%, the 2-year Treasury rate 3.54%, and the 10-year sitting at 4.04%. So that's the pricing. Any comments there for listeners?
No, I think the long end of the yield curve is really interesting to me right now. I think that it is an average investor's expectation that if the Fed lowers interest rates next week, and let's say they have a few more cuts over the next 12 months, that the longer end of maturities will respond appropriately. And so far, you've seen them come down a little bit, but not much. And I just wonder how sticky and how, let's just say in very plain English, how long rates are going to stay high for the longer maturities. I just don't think they're going to come down as quick as people think.
What's your take on that? You think that's good for people?
I think about the consumer, right? I think about mortgages, and I think we really need the long end of that curve to come in. I think about business spending. I think about their need for smaller and medium-sized businesses to borrow money. We got to get the long end of the curve down, but it's going to be tough to convince people to, hey, buy this 30-year Treasury when we have, sticky inflation around 3+%, right?
Yeah, absolutely.
It's a tough sell.
Yeah, it's a
tough sell.
Yeah, indeed.
You want to talk about big headlines and current events, Nick?
Yeah, absolutely. Just a couple things for listeners. The next FOMC announcement on interest rates is due 9/17 at 2 p.m.
So next Wednesday,
that's
baby.
Next Wednesday. The market is pricing in basically 100% chance of a quarter point cut, 25 basis point cut.
Yes.
And forecasting at least 3 cuts through the end of the year.
It's interesting because that's based upon interest rate futures on the Chicago Mercantile Exchange, which is a futures exchange. So there's big money behind that. So the expectation again is we're going to have some downward pressure at least on shorter term interest rates, and we'll see how that affects the entire system. Remember, we got over $7 trillion sitting on the sidelines in money markets. Right now, it's enjoying 4+% on a risk-free rate. The existential question, Nick, is what happens when that money is yielding a lot less? Will you start to see some of that come off the sidelines and go elsewhere? We will see, right?
Yep. And just to follow up on the percentages, 89% right now as of this morning being 9/11 at approximately 9:07 a.m.
Love it.
Eastern time.
Love it. Timestamp it, baby.
The market expectations are 89.1% for a quarter point cut and 10.9% for a 50 basis point cut. So 100% of the market is expecting a rate cut.
Yeah.
Just the difference of how severe the cut will be.
My hot take is I think 50 basis points would shock the market to the point where it's like, okay, what does the Fed know that we don't?
Yeah, I agree.
So I think 25 would be methodical.
Yeah, I agree. The other two headlines, numbers, data points to be aware of is the PPI data. That's the Producer Price Index, was up 2.6% in August versus 3.1% in July. Those are annualized numbers, of course. And a reminder that's inflation on the supplier side of things.
Well said.
Producers,
well
so
said.
to speak.
Yep.
So good to see that coming down. The key takeaway there is that the report is going to ease some of the market's angst about pass-through effects on the consumer.
Tariffs.
Exactly.
Mm-hmm.
And then the CPI data came out this morning about 40 minutes ago. It was a little hotter than expected. The annualized numbers sitting at 2.9 versus 2.7 previous. The consensus was 2.9, so it came in as expected. Still a little, obviously, above the 2%, but seeing it meet consensus, I think that's a good thing. I think the market will be okay with those numbers.
You and I said it before we started recording, talking about just briefly some of the real-time data from this morning, i.e. the CPI numbers you just mentioned. I think 3 is the new 2, and this is why the Fed has dropped that 2% target mandate and going with full employment. The pain the economy would have to endure to go from 3 to 2 would be substantial, in my opinion.
Yeah, and we've talked about this over the past couple of years on the podcast about how much more difficult it is to get inflation from 2.9 to 2 as opposed to 5 to 3.
Yeah.
That last percentage is
incremental is hard.
Very difficult. And there's a way to do it, but like you said,
It's painful.
It's painful and can really cause unemployment to jump.
Sure.
Which no one wants.
Exactly.
So.
Exactly. What caught your eye this week? Tweets, articles, research? Where's your head at this week?
Yeah, a couple things jumped out to me. The first is on market breadth. I've seen market breadth.
I always love market breadth stuff.
It's good. It's important. I've seen it percolating in the news a little bit, so I took a little dive onto that, and I came across something that Ryan Dietrich posted on Monday on X. And he said, remember when the S&P bottomed exactly at the lows of April 2024, the overall breadth of the market held up very well. Not to mention high yield held up as well. If you ignore all that scary news while you were selling, there were so many clues a huge summer rally was coming. And it's just an interesting chart here that he has that kind of shows you the advanced decline line. And he kind of marks up the chart, and so that you can see whenever the market was really coming under hard times back in April, market breadth actually held up pretty well. And a reminder, market breadth basically is the full participation of the market. So not just one section of the market is falling apart.
How well in general, the market in general, the number of names moving up versus the ones that are moving down. And when you have a substantial portion of all stocks moving up, that is definitive of more of a bullish uptrend where everyone's participating. And
the vice versa is true if you have 500 stocks in the S&P and all 500 are moving down, then that's
more of a definitive move to the downside.
Exactly. So we didn't necessarily see that in April, and he marks this up with the chart, and then obviously we know what has happened in May, June, July.
Yeah.
The market kind of rallied. So any thoughts on that?
I like watching this because of the top-heavy nature of the S&P 500 being a market cap weighted index.
Absolutely.
And another way to say it for our newer listeners is the perception is, there's 500 stocks in that index. Well, guess what? The top 20 names make up like 80+% of the actual market cap of the index. So you could, in theory, have those top 15 or 20 names doing well, and the perception is the stock market's doing great, right, Nick? But the other 480 could be doing horrible.
Yep.
And this is the type of data that tells us, is it just a couple of names doing well, or is it the broader market?
Right.
In the last couple of years, the leadership's been very narrow.
It has, yeah.
Right?
It's been very concentrated in the mega cap names, and that's why they get so much media attention as well. They're so big, and they can move the market. When one of these big guys has a terrible report, and they can really drag the indices down. It's just it's a percentage thing.
Yeah, it is, isn't it?
Yep. So the second thing I had is a little bit more of a deep dive on the revision of the annual jobs numbers. The reason I wanted to jump into this is because I saw a few headlines, and I know just on a quick Google search that I think this is probably going to pop up on a lot of listeners' main source of news. The revision, the U.S. economy added 911K fewer jobs in the 12 months through March 2025 that initially reported. So that was the largest downward revision since at least 2000, and that's according to the Bureau of Labor Statistics preliminary benchmark revision. I saw this headline kind of flash, and I saw some political headlines kind of flashing around this. We can talk a little bit about the politics at the end of this. That's not really my concern. I more just want to provide some background for listeners so that they can kind of understand this and not get too distracted by the political nature of this. So first, a couple points. The latest figures that I just quoted, let's say it's almost 1 million revision. They suggest that the labor market has weakened more than previously thought. That's important, right? That means essentially the payrolls, the jobs report that we talk about every month, they come out and they say, okay, 100,000 jobs were added. And the next month, 200,000 jobs, whatever. And then this past report, this headline that you guys have seen, they basically said, actually, based on new data that we're reviewing, we overestimated all of those reports by about 1 million jobs. It's, again, 911K.
Yep.
So that means the labor market was materially weaker than we had previously were under the impression of.
At first glance,
year over year from March, right?
Correct.
The reason that's important is because of what we were just talking about, the Fed rate cut. That gives the Fed another feather in their cap to say,
hey, we can justify lower rates.
Yeah, exactly. So that's the first point. The second point is, yes, this seems like a massive revision, and it is on the year-over-year numbers, but in general, the U.S. economy employs 163 million people, 163.3 to be precise.
So let's start looking at the math side of this.
Yeah, look at the math. Let's look at the big picture. Let's look at the quantitative side of things. And a revision of 1 million across 12 months is not that large from a quantitative point of view.
The sample size of the pool.
Just looking at how big the U.S. economy is. So those are the 2 points that I want to make. First is that it does give the Fed probably a little bit more ammunition to cut rates and start the rate cut cycle, which we all expect. And second is, let's not get over our skis with any kind of headlines that you're reading that, the BLS is broken. I'm sure there are things in there that could be improved, just like every agency, just like every company, just like every individual in the world. We all have room for improvement, but just want to point that out. Do you have any other comments before I kind of go into the process of how this is collected to help listeners?
Yeah, no, I want to be careful on the political side because I know this has been very much politicized.
Yeah, of course.
On both sides of the aisle. I don't think it was any secret that the last roughly 5 years, every time they had a monthly jobs number, the next month when the new jobs number would come out, there would be a revision for the previous month.
Yep.
And I want to say, I'm not exaggerating, 9 times out of 10, it was a revision downwards. So it was almost like the market itself was just started, and I did it myself. The number came out at 100,000. I would always be like, yeah, it's 80.
Right. Yeah.
I hate to say it. That's
what you
the last
start
5
to do
years,
when you see
how
the
I started
revisions.
looking at the numbers.
Yeah.
So when I kind of see this revision, to me, it's like, oh, yeah, that's par for the course.
Yeah, that checks out.
Yeah.
Right. Yeah.
But I obviously, we live in just a polarized political environment. It feels like right now everything's tied to a side of the aisle. It's crazy.
Right, exactly. And so I wanted to jump in and kind of understanding the process and explaining like, how does this work? Why does it happen this way? So the BLS compiles the monthly employment data, the jobs report, from 2 surveys.
Yep.
One is pertaining to payrolls, which is gathered through a survey of businesses.
Mm-hmm.
The other, the survey of businesses, they don't affect the unemployment rate. The unemployment rate is devised from a second survey, which is a survey of households.
Mm-hmm.
Okay, so that's how the monthly numbers get generated.
Sure.
Right? 2 different surveys,
Yep.
households, businesses. The big revision, the one that made the headlines this past week, that comes once a year. The BLS benchmarks March payroll level to a more accurate but less timely data source. That data source is the quarterly consensus of employment and wages. Okay, so that happens once a year in March, where they kind of get all this new data that's obviously on a pretty big lag.
Yep.
And the preliminary numbers apply to the total level of March 2025. The final month-to-month official revisions will finish in 2026. So what that means is, okay, they come out, they get the quarterly census of employment wages data, and then they quickly give the total headline number based on that data, just kind of do a quick preliminary analysis, and they say, hey, we overestimated jobs by 1 million this year. Last year, ballpark, 900,000.
Sure.
Last year, I think they missed it by 800,000, overestimated again. The year before that, I think it was like 400, and the year before that, I think they were on the other side, like 400.
Okay.
So the reason that this data is more accurate is because it's based on state unemployment insurance tax records, and it covers nearly all of the U.S. jobs.
A little more accurate, in my opinion.
Absolutely.
Laggy data, but accurate.
It's much more lagging data, but it's much more accurate because you're looking at all of the data.
Yeah.
You're not gathering surveys.
Yes.
The surveys are just that. They're surveys. They're helpful, but you have to then program algorithms and try to basically project what's happening across 163 million jobs.
Yeah.
Surveys are also just that. They're surveys. You need participants to participate.
Yeah.
How many people at home or listening to this get a survey on their phone and participate?
Not
or
many.
when someone asks, hey, can you leave this review for our business? I mean,
not many.
So collecting survey data is hard. It's hard. So there's going to be issues with revisions regardless. So that's something that I just wanted listeners to be aware of. The question of, okay, well, why has it been so drastic? And is it drastic? A, we've kind of gone through that. And B, why is it so drastic? Yeah, it jumps out a little bit in the past 2 years. I think the chart that I saw online, your revisions are typically more in that kind of like 200 to like 500,000 range on either side.
Sure.
Overestimated, underestimated.
The normal range of variation.
Right. The past 2 years, we've been at 911, and then it's in the 800s. I don't have it in front of me, but it's right in that range to overestimating. Mm-hmm. So they said, hey, we added more jobs than they actually added. As to why this is happening, economists no one can necessarily agree, but there are some different ideas out there. One has to do with the birth-death model, which is basically an adjustment that the BLS makes to data to account for the net number of businesses opening and closing.
Okay.
Which I'm sure they had to tweak during COVID. And then
that was really skewed, right? It had to have been, right?
Right. And they actually did really good with the COVID numbers. Looking back in 2020, 2021, 2022, those revisions were actually very accurate, but I think maybe however they've tweaked the model to deal with that on the survey data, maybe they need to tweak it again.
Sure.
Because the past 2 years have been pretty notable misses in general. So that's one piece. The second piece is immigration. And again, some economists are saying, oh, it's the birth-death model. Some are saying, oh, it's immigration. And that's because the QCEW, again, that's the quarterly census of employment and wages, mm-hmm. is based on unemployment insurance records, which immigrants can't apply to. Thus, the difference could be unauthorized workers that are included in the payroll figure. So you're basically including a huge section of the economy in your survey data that you're not getting in your other data.
Could be.
So I think the truth is probably in the middle, mixed into all those kind of algorithms and things that they have going on. I would not, if I'm at home and I'm a listener, I would not get
hung up on these
headlines.
headlines.
I would not get hung up on these headlines at all.
For me, these are data points.
Exactly.
And what happens is sometimes when you get a large number, it can seem like a definitive piece of data that investment decisions should be based upon. Mm-hmm. And my words of caution is shouldn't be a sole factor on investment decisions. It's a data point. That's my kind of summary on that.
Absolutely.
Yeah.
Absolutely. Yeah. And again, I would like to leave that with 163.3 million. A revision of 1 million across 12 months is not that big in the grand scheme of things.
Got to look at the math side of it.
Let's look at the quantitative and let's. Yeah,
I think it's good because what you did there for me in plain English for our listeners and viewers is you're dispelling the clickbait aspect of some of these headlines and how on initial first glance that could be a jarring statistic.
Yeah.
Right?
Yeah, absolutely. Yeah. The last piece I had is on the history of the bull markets. This was an ex-post from Urian Timmer.
We got something similar this week, you and me. Oh, this is going to be fun.
So Urian said the S&P 500 index has now gained 88% since the cyclical bull market started 35 months ago on October 13th of 2022.
That he said that correct, listeners and viewers. We are in an uptrend. We are currently in a bull market.
Yes. The median bull market lasts 30 months and produces a 90% gain. So this one remains on par with history. And then he has Urian Timmer always has really cool looking charts. So we'll throw that up, or if people want to jump online and check out the show notes, you can see this chart that just shows all of the different bull markets on a chart and shows it based on duration and obviously the percentage gain, and you can see that. So
I'm going to take it one step farther since we have a similar topic. So mine was from a post from Grant Hawkridge from All Star Charts on August 28th. Similar data, but a little bit deeper.
Okay.
So what Grant posted is in regards to this uptrend, this bull market, the definition of a bull market is one that of which the follows. It rallies 20% off of a low, and once you make a new 20% high water mark off that low, you're in a bull market. And as long as you don't sell off at least 20% during that uptrend, you remain in a bull market. The market could right now sell off 19.9%. And if it doesn't break the 20 on a closing basis, it still would fit the mold of a bull market. From 2009, for about a decade, we were in a bull market, and there was several corrections along that way where it sold off almost 20% several times, but we were still in a bull market. So follow me here. Mm-hmm. You mentioned where we stand off of the current bull market. Mm-hmm. Grant's data indicates that we are 721 days into the current bull market. The average length of a bull market going back to the 50s is almost 1,150. It's 1,148. It's the average length. We're at 721. You mentioned the median return since that time period of the average uptrend or bull market before it sells off and negates it. You said that was about 90%. That's correct. The average, though, was 154% when you slice and dice the math.
Yep.
Let's go a little bit deeper. There's got more stats. So when you start visually looking at this, that's in table form. Grant on this post had it on a visual basis, and you can kind of see that average length, the average rates of return. It helps put into perspective that when you look at the lens of history, another data point, that shouldn't be a sole deciding factor on your investment decisions. we are nowhere near the average length in either time or return of the average uptrend. Okay? I just want to throw that out there. That was the point that I wanted to make to kind of take it all the way home. I got another piece that kind of talks about, recent performance in the S&P. And this is from Bespoke. And Bespoke had a piece, Nick, on August 30th, and this is what it said. The S&P just rallied 25% plus over 100 trading days for the 12th time in the last 70 plus years. 3 months later, after it does that, this is the scary part, it was higher every time. So the data said, I'm going to yell off the years for our traditional podcast listeners. This occurred in 1975, 80, 82, 86, 87, 91, 97, 99, 09, 2020, 2024, and now. The average return 3 months later of all those years was 6%, 6 months, 8.5%, 1 year later, 12.5%. Why am I highlighting this? Investor psychology. We like to go to the store and we like to buy stuff that's what, Nick? It's on sale, baby.
Yeah,
I want a deal.
We like a deal.
We like a deal, right?
I like a deal.
Segueing, if anybody in this listener, in our podcast listeners, needs someone to go to an auto dealer with them, you need to bring my older brother, Andrew. This guy makes a case of like sitting there and haggling and negotiating the best deal possible on cars. Okay? We want that, right, in the stock market.
Oh, yeah.
Problem is the market's rallied 25%. Okay? So the perception in the investor psychology is, I can't buy stocks now. Nick, they rallied 25%. When you look at the lens of history, that's not necessarily a bearish indicator. And the Bespoke and the data speaks to that. My last thing that I have this week is a reminder that catchy phrases, like things you hear in the market, shouldn't supersede your long-term financial plan. So when you hear all these crazy phrases, Nick, the one that got real popular is sell in May and go away. All right? So this is not an exaggeration. When I started in the industry in the late 90s, I saw financial advisors who literally employed this investment strategy for clients. Literally, they would be long the market, sell out, go to treasuries, rebuy in November. For a long time, this seasonality worked well for them. So when you see this, people think, oh, this is an investment strategy I should consider. And when you really look at the data, trying to time the market on a short-term basis is really, really hard.
Yeah,
and you saw all this clickbait earlier in the year. The market corrected 20%. The low was in early April. You get to May. You saw all these headlines about sell in May and go away. And what happened during that time period? If you would have done that, you would have missed out on a 17% gain in the S&P. And this post by Peter says, don't trade slogans, stick to your plan. And again, it's just throwing it out there. A lot of clickbait out there in the financial news world. Your thoughts?
Yeah, my thoughts center around one general idea or thesis of investing, and it's what I tell people, peers, friends who aren't in the markets, who don't work in this industry. It's the same thing I tell them. Investing it's a long game.
Yeah.
It's not just invest and be patient. We're talking years and years. That's the purpose of it. It's not.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
It's not gambling. It shouldn't be. It shouldn't be treated that way.
But Nick, we live in this world of instant
Instant gratification is
like
not-
I buy
this is
this
not-
stock, it should be up 10% in a week. Come on, Nick, why is it not doing that?
That's not how the market works. Now, don't get me wrong. There are stocks that you can buy and trade that, sure, they give you that opportunity. But again, there's a reason that they're jumping 30% a week or falling 30% a week, and it's because they're more volatile investments. And I think sticking with your long-term horizon is obviously extremely important. And just understanding that these are investments and they take time, and you don't have to look at it every day. I tell people not to look at it.
Absolutely.
I tell my friends who've asked me, what do I do? I just don't look at it. Just get in there, get some, buy some stocks, buy the S&P or however you want to, whatever your approach is.
There it is.
Everybody's approach is different.
Yep.
And just hold it. Don't freak out about it.
It's time in the market, not timing the market, in my opinion, that gives investors an edge.
Yeah, absolutely.
But we live in this society of instant gratification.
We do indeed. I understand.
Everyone wonders why Warren Buffett's been so successful.
He's probably the most patient investor of all time.
Time is on his side, right?
Yeah.
He wasn't ultra wealthy till later in life.
Mm-hmm.
People think he's been ultra wealthy to this magnitude his whole life, and he hasn't been.
No, he
It's
built
just
his
time
wealth.
and compounding has been on his side,
Yeah.
right?
Yeah,
That's the reality of it.
Yeah, he bought and held.
He bought Coca-Cola back
yeah.
in the day. He bought American Express. Not a recommendation for or against these names, but you look at Berkshire Hathaway's top 10 holdings, it's some of these longer-term names, right? He's held them for decades.
Yeah. Decades.
Decades.
Yeah.
Decades.
And important to note that a lot of times after he makes an acquisition, he doesn't see a return for 7 years. I mean, it's not, it's a patience game.
Yeah. And I'll also throw out there, he's far from bulletproof. He's definitely had his investment decisions that didn't go his way.
Absolutely.
But like any other investor, we only talk about our winners, not our losers.
It's more fun to talk about the winners,
It
isn't it?
is. Any other thoughts? Signing off, we'll skip the financial planning topic of the week. Thoughts before we sign off this week?
No, that's everything I had. Just a reminder on the jobs report again next week. So we'll see the market. I think the market's going to handle everything very smoothly. I don't expect any kind of craziness next week, but it's a big report nonetheless, because it marks a turning of financial policy, of interest rate policy.
Well said. I'll sign off in a little more general kind of terms. Today's 9/11. So we all remember where we were on 9/11 when everything went down that day, and we all have our stories in regards to that. A lot of things happening over the past week and here in the U.S. So things just feel a little heavy, intense, right now in society. So I wish everyone a good rest of the week. And we'll be back next week for episode 318 of the Independent Advisors Podcast.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.